Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is July 25th, 2024, and today we're going to look at after GDP, investors bet on recovery and against inflation. Now, that's a weird turn. We kind of turned inside out. We kind of went backwards on what we might expect with a better than expected growth number. GDP, advanced GDP specifically, came in higher than expected. And that higher than expected GDP would be an indication that we are actually growing faster and accelerating compared to last quarter. Last quarter reported in at 1.6% and then was revised lower to 1.4%. And then today, advanced GDP for this quarter came in at 2.8. So we're seeing a significant shift, a significant change in expectations on growth. We're seeing expansion. We're seeing acceleration, nearly twice what last month was after the revision. And yet, you look at this and we have now broken through the major support level. In fact, we're trading all the way back to the lowest level that we've seen, going all the way back for nearly 7 weeks. So we've erased 6 weeks of data in a matter of 2 weeks of trading. Very aggressive sell-off, nearly 2 to 3 times the speed of the acceleration, which was explosive, back down and erasing all those previous gains. So it's actually kind of a little bit nerve-wracking to see the change in the shift there. And we're now saying, if this is broken through here, are we going back to retest these previous highs? The interesting aspect of today, just today, focusing on today, if you're to look at the sectors that were bullish, the sectors that were positive, we had energy, industrials, financials, and basic materials. Oh, and copper. But energy, industrials, financials, and basic materials are all the sectors that grow or start growing or become the dominant sectors in a recovery phase. So the ones that won? Economic recovery stocks. Energy, industrials, financials, and basic materials. The ones that lost? Technology, communications, and utilities actually ended up pretty low today as well on that pullback, and that was being driven by bonds. So the numbers would suggest that if we were to go off a single day move, then today was the indication that we are now in early expansion. Early expansion, middle expansion, seeing money move into the industrials and kind of in that growth phase of the market. Now, financials can be part of the recession. They can actually do better during the recession. But it's interesting to see that recovery and that growth. Now, if we look at energy, energy had a nice bullish bounce today. And if we take a look at CL for crude being the representation of energy prices and not just the performance of the underlying, crude had a very wide range today. Very significant trade down to the lows, recovery all the way back up and closing higher. And it looks like we've established kind of a base through here that could push us back all the way up to $82 a barrel. Now, that would be inflationary. We'd think that higher costs, finding a base and pushing higher, that would be inflationary. And if growth is there at 2.8%, you might also expect that inflation is going to stick. Well, if you take a look at gold prices did not perform well. In fact, gold sold off 2.3%, followed the market, broke down, and tagged the lowest price since July 3rd. So about 3 weeks out, erasing all the growth again and the defense or the hedging of inflation. So why is it that we're dropping the inflation expectations when reality is we're also pricing in recovery and growth? Doesn't seem to mesh very well. And where technology is selling off, where's our next trade there? Let's look at industrials first as far as a setup for trades, and then we will look at technology to see when is the low. When are we going to find the base? Are there trades we can be taking in technology as technology is corrected quite a bit? Industrials traded all the way up, erasing all of yesterday's selling, pushing well beyond that, and then falling all the way back down. Now, this is one of the few sectors that was able to recover all of yesterday's sell-off. Now, banking and finances would be another one that did. But industrials, as you can see, we traded all the way up. Huge day, very large day, trading 3 points, almost 2.5% higher before settling in about 1% up. Now, that does not mean that this is the best place to play, but it is at previous support acting as, or previous resistance, excuse me, acting as now support. If we look inside of industrials, the top performing have been machinery like Caterpillar and Deere, but all the way back to our discussion from a few weeks ago, aerospace and defense. So we can take a look at something like Raytheon, and see huge response to earnings. Raytheon beat expectations, gapped up, closed higher, and we priced in a huge gain. Now, this pullback is about halfway. I would say let it breathe out to about 112, and I think then you have a continuation higher in Raytheon. If you look at Northrop Group, NOC, Northrop Group did a similar thing, major outperformance. And as far as this expectations, we're expecting 590. It came in at 636, gapped higher, closed higher, and we saw a 35% jump. Now, again, I'd let it breathe out to about 465 to 466. And then I think topside targets back in play. We could really see this push all the way up to the previous highs. And a company even like Boeing that has been beat up and knocked down because of all of its problems, are stabilizing in this area. They have earnings coming up. I think they've probably taken most of the hit they're going to in their earnings, and so it could be getting near a time that you can start selling puts against something like Boeing or put verticals to collect premium on the stock as it continues to stabilize and recover after such an aggressive sell-off. Now I'm going to talk about Boeing and segue into Microsoft. Now that may seem like a weird connection, but certainly not with what's going on this week. This week we had all the surprise shutdowns. We had the situation where Microsoft backed Crowd, CRWD, and all the shutdowns that caused all the shutdowns in the airlines have really put a damper on things like Delta and jets. And we're certainly going to be watching for those because there's still some hits that are going on, but jets created an outside day and maybe found the base. But Microsoft, if we look at Microsoft as an AI stock, as a technology stock, as a communication stock, we're seeing Microsoft falling down and down and down. The question is, where is the right time to step back in? AI stocks were the high flyers. Microsoft is classified as an AI stock. As we're watching Microsoft, we've sold off, reversed the breakout, pushing lower, should be looking for a test of about 410, and from there 390. The question is, do we need to wait for it to fall all the way down to 390? Microsoft is still, I think, reeling on its heels from this last week. If we look at the other stocks that are in this AI sector, and technology and communications getting knocked down so far, looking at the ones maybe that are a little bit less used or less known, like C3, you can see that it's stabilized at a previous gap. So this is C3 AI. We gapped up on last earnings. It tested that as a floor or support level, which is a previous resistance, which is a previous floor, which is a consolidation area. And what do? We gapped down to it, tried to push through it, and recovered. AI, or C3 AI Inc., AI is a ticker symbol, looks pretty decent as a low-cost, low-risk entry back into the AI space, potentially. And looking across the board, we still have NVIDIA, we still have Google and Google's expansion in the AI space, making it more readily available. Google still has some downside following Microsoft. I'm looking for Google to find 165. If we look at Palo Alto Networks in the cybersecurity space, you can see that we've fallen back to previous resistance, previous consolidation, and similar to C3, this could be a low-cost potential entry back into the AI space. If you think that AI is going to be continuing to grow now, that we're still in this expansion, that this isn't a dot-com type of bubble burst, it is simply a correction on an overbought sector, these levels are potential levels to get back in the trades. And I would definitely encourage you, if you haven't done so and didn't get a chance, go watch Gianni's discussion on AI. Today, he gave a very cool class on AI timing, how they're unique to each individual AI stock. So Microsoft still has some downside. Google has some downside. Palo Alto, C3, may be poised for a new opportunity to buy. So I would definitely encourage you to go back and rewatch that and pay attention to the way he's looking at tracking them, because the performance on AI we've already seen can be double, triple, better than what we've seen in crypto, better than what we've seen in pretty much any other space. So now the question is, are we getting the discounted prices to step back in? Are we seeing the opportunity to re-enter into those spaces, and can we time it so that we can get in at the right price? And unless you think that AI is not going to continue to expand, if you don't think that's going to be the case, don't step back in. But if you do, these are the areas that I would be looking. I do think that inflation, going full circle, will have an impact on AI. And as we're looking at inflation and inflation data, if we have higher inflation, we have to keep rates higher. If inflation is fading, then rates can stay where they're at and go lower, which means more investing into the AI space. If we look at TNX, or the 10-year Treasury yield, we can see that we're kind of holding down here in these lower values. We're near 4.2 to 4.3. That is still near a multi-month low, and the anticipation, the pricing in of rate cuts is still relatively high. We're pricing in 2 rate cuts by the end of this year. And this level, if we do see those rate cuts, will likely push back down to 4% and see more money flow into AI. In addition to that, gold prices, again, sold off. And if gold prices sold off today, and if we're seeing gold pull back to its next major support level, then gold prices pulling back here is showing that we are not hedging inflation at this moment. And that's another good sign that money should be easier access for those tech stocks, and even the small caps, but definitely the tech stocks. And if we look at something like Freeport, who would benefit from higher gold prices, you can see they're still in a decline. So the anticipation is future margins, future revenues are not as high or not as good for someone like Freeport or for Rio Tinto. Rio Tinto is copper primarily too, but they do a lot of mining. So that is showing us that we're not really pricing in higher margins. Therefore, gold is pulling back, copper is pulling back a little bit to the lows too, and we would therefore be looking for less inflation and stable or lower interest rates. And even though this is a little bit off topic, as we're watching this, I was looking at consumer staples and consumer discretionaries. Consumer discretionary and consumer staples were right about 0% return. And it looked like we were rotating into trusting that the consumers were going to do well. But my last thought on this would be this. Visa is a stock that follows or gains from transactions. Less transactions, whether consumer staples or consumer discretionary, is going to hurt Visa. Visa hit a 6-month low today. Visa has always been my canary in the coal mine. If we see this continuing to go lower, then Visa is telling me that we are not in a healthy economy, which probably does mean less inflation, less growth. As long as we don't go into stagflation, then we can see less growth slowing down of the economy. And as long as Visa is in a free fall, I would not be betting on consumer discretionary or consumers in general to prop up the market. The signs that we saw rotation into industrials and energy could be temporary, and I'm having a hard time seeing that the long term can really win if Visa and consumers are struggling. On the yearly view, I think we are still heading down to probably test 247. So we still have a little bit of downside, probably looking at another 2% decline before we even start to stabilize. And this is on and after earnings gap down, close down. It does not look like the guidance or the future is looking as bright for the consumers as being represented by Visa transactions. That's going to do it for me today. Thank you for watching. Join me again next week on next Thursday's video, and also join me and Brandon as we host Gianni tomorrow morning. He will continue his everyman's way to pick from the expansion of AI and show you the timing of some of those as we pick some individual stocks in the morning pre-market. They'll be complementary to what he discussed today.